Money promises clarity. It arrives in clean, hard numbers that feel absolute, objective. Numbers look solid, they don't seem to have an opinion, they just are. Paychecks arrive and the number at the bottom tells a story of reward for effort. Prices on a shelf seem to state a simple fact about an item's cost. Account balances give a snapshot of my financial health, a single figure to hold on to. But there's a hidden trick in how my brain reads those numbers. A cognitive blind spot that distorts their true meaning. Economists call it the money illusion, a deeply ingrained tendency to confuse nominal dollars with real value. We see the number, but we miss the context. We value the symbol over what it can actually acquire. Here's the reveal. It starts with two simple terms: nominal and real. Nominal value is the face value of money, the number printed on the banknote or displayed on the screen. It's the number we see every day. Real value is what that money can actually buy. It's the money's purchasing power, adjusted for what things cost. If my salary climbs 3%, while the average price of everything I buy rises 4%, the nominal number went up, but my real purchasing power actually fell by 1%. I am measurably poorer. My brain, however, still feels richer because the digits are bigger. It latches onto the positive signal of the raise and discounts the negative signal of rising prices. That's the illusion. Inflation is the quiet stagehand in this theater of value. It operates silently, in the background, rearranging the set. It shifts every prop, wages, rents, savings, so the scene looks the same, while its fundamental meaning changes completely. This is why headlines about record market highs often don't mean record value. A stock market index can hit a new peak in nominal terms, celebrated on the news, while, after you adjust for inflation, it's still catching up to a previous high from years or even decades ago. The numbers are bigger, but the value isn't. History is filled with these moments. During the Great Inflation of the 1970s, many people saw their wages and stock portfolios grow in nominal terms, but inflation was so high that their real wealth was plummeting. They were running on a financial treadmill, working harder just to stay in the same place. The same illusion played out after the 2008 financial crisis, and again during the inflationary spike of the 2020s. Each time, the headlines focused on the nominal numbers, while the real story was hidden in the background. The illusion thrives because wages are sticky. Bosses avoid cutting nominal pay because it's terrible for morale. A 2% pay cut feels like a personal failure. So instead, inflation does the work for them, gently lowering real wages over time without anyone having to have an uncomfortable conversation. A 0% raise in a 2% inflation environment is a real pay cut, but it doesn't feel as bad. Prices are sticky too, but for different reasons. Businesses face what are called menu costs, the literal and figurative cost of changing prices, printing new menus, updating websites, renegotiating contracts. It's a hassle, and we, as consumers, are creatures of habit. We expect a certain price for our morning coffee, so when costs rise, but companies want to avoid changing the price tag, the value quietly changes instead. This is shrinkflation. You get smaller packages, fewer features, lower quality ingredients, or slower service. The sticker price stays the same. The value slips away, almost unnoticed. This illusion is especially dangerous when it comes to savings. Cash feels safe because the nominal number doesn't change. $1,000 today is $1,000 tomorrow. But money sitting still is never truly still. It slowly, silently leaks purchasing power. It's like a bucket with a tiny invisible hole. Even a seemingly low 2% target inflation rate, the goal of many central banks, halves the real value of idle cash roughly every 35 years. Over a lifetime, that's a catastrophic loss of purchasing power, all while the nominal number on your statement looks perfectly stable. Interest helps, of course, but it only truly helps if it beats the combined drag of inflation and any taxes or fees. This brings us to one of the most useful tools for piercing the illusion, the Fisher equation. It's elegantly simple. Your real rate of return is approximately your nominal rate of return minus the rate of inflation. So if your savings account offers a 5% nominal yield, but inflation is running at 4%, your real return is only 1%. You're barely treading water. If inflation were 6%, you'd be earning a 5% nominal return, but a negative 1% real return. You're getting richer in nominal terms while getting poor in real terms. My brain loves anchors. It's a cognitive bias where we over-rely on the first piece of information we see. Last year's bonus becomes the anchor for this year's expectations. A round number salary, like $100,000, $100,000, feels like a significant milestone, regardless of what it buys. A $9.99 price feels fundamentally cheaper than $10. These nominal anchors blur the real trade-off I'm making every day, exchanging finite hours of my life for slices of real purchasing power. So I have to consciously reframe. I have to build new mental habits to see through the fog. The first reframe is to translate money into time. What does this purchase cost? Not in dollars, but in hours of my life, at my real, after-tax, after-inflation hourly wage. A $150 dinner is no longer just $150. If my real take-home pay is $50 an hour, that dinner costs 3 hours of my life. Is it worth it? This simple conversion punctures the halo of big numbers and grounds the decision in a resource I can't earn more of: time. The second reframe is to always ask, what's the real return after everything? Not just after inflation, but after taxes and after fees. These three forces, inflation, taxes, and fees, are the primary drags on wealth. The nominal number is just the starting point. The real number is what's left after these silent partners have taken their share. So, how do I make this practical? I follow a checklist. First, think in real terms. Adjust everything for inflation. My salary, my investment returns, my savings, always. Second, prefer rates to stories. A flashy story about a stock hitting a record high is less useful than its compound annual growth rate, or CAGR, adjusted for inflation. CAGR smooths out the volatile ups and downs and gives a clearer picture of long-term performance. Third, match horizons. The purpose of money dictates its form. I use short-term, stable cash for near-term needs, accepting that it will lose some purchasing power. But for long-term goals, I need assets that have a chance to outpace inflation over time. Holding too much cash for too long is a guaranteed way to lose. Fourth, focus on cash flows, not just sticker prices. For an investment, can the asset pay me through dividends, rent, or interest? And can it do so sustainably with the potential to grow faster than inflation? Fifth, diversify and rebalance. The money illusion loves extremes and certainty. Diversification across different asset classes is a hedge against being wrong. It's an admission that the future is uncertain. Sixth, beware shrinkflation and quality drift. I need to actively audit what I buy. Is the package the same size as last month? Is the service as good? The price tag is only one part of the value equation. Finally, always ask, compared to what? This is the antidote to anchoring. A house that's up 30% in nominal value feels like a huge win, until I net out inflation, taxes, maintenance costs, and the cost of capital. Compared to a simple index fund over the same period, was it actually a good return? A 5% raise feels generous, until I map it against the rising cost of my personal basket of goods. If my rent, gas, and groceries are up 8%, I've lost ground. A high-yield savings account looks great, until I subtract my tax bracket's bite and the current inflation rate. The high yield might actually be a low, or even negative, real yield. Seeing through the money illusion doesn't make me cynical. It doesn't mean money is meaningless. It makes me precise. It forces me to be an empiricist in my own life. When the number on my statement gets bigger but the life I can afford with it doesn't, I know what changed wasn't my wealth but the measuring stick itself. With this clarity, I stop chasing nominal digits and start making decisions based on what I'm actually trying to buy. I'm buying time, resilience, options. These are the real currencies, and they aren't measured in nominal dollars, but in the quality and freedom of a life well lived. If this shifted how you see money, like and share, so someone else can see through the fog. Money illusion, not our economics. Explained, somewhat our hidden rules.